Hey everyone, I am Stephanie Patterson. I'm with the Cole team with Compass, and today I am here with Tony Davis. Hey, Tony.
Hey, Stephanie. Hey, guys.
As you can imagine, many of you woke up today with some incredible news, pretty monumental really for your business, Tony, and for mine. Mortgage rates fell to an all-time low for a 30-year fixed. I've never seen anything like it, and I'm so glad you could join us to kind of give us your take on it, Tony, see what people can expect and really why it's happening and all that kind of good stuff. So Tony, I'll let you take it away.
Yeah, sure. So the coronavirus is causing a lot of havoc in the mortgage world because there's, usually when, obviously with coronavirus, nobody wants to get it. Everybody's trying to, if you look at China and the other countries where it's running rampant, they're even quarantining cities. So we think, it's just the tip of the iceberg in the US. They haven't even really rolled out testing it yet. So we think that it'll continue to run its course through the US. And as that happens, you look at what other countries happen to their economies. It's probably, going to be similar here, where just the port in Los Angeles, for example, largest port in the whole country, shipments are down 25% just in February. And that was when the coronavirus was just getting started. So you look at, a lot of people as it gets more rampant, are you going to go out to the movies as much, go out to dinner as much? Business travel is down 50% right now. And you cancel big conferences for Google's canceling conferences. That money doesn't come back. It's not like you can do 2 conferences next month to make up for it. So that's going to have a ripple effect on earnings in the stock market. And that's why you're seeing this. You look at your 401k, it's probably getting pounded right now because every day, the market's expecting that there's going to be bad earnings in the future as this runs its course. So usually when there's a lot of selling like this in the stock market, the money goes into what people perceive as safe havens like bonds, in particular long-term US treasuries. So if you look at the chart of the 10-year US Treasury as of today, it's down 65% in 3 weeks, which is insane. 10-year Treasury is 70 basis points, so less than 1% to loan money. What that means is if the US government pays 70 cents or 0.7% to borrow money for 10 years, so almost free. So the 10-year Treasury is kind of the benchmark for mortgage rates, and that's caused mortgage rates to improve to levels that they've never been to ever. So earlier this week, they were kind of in the low 3s. We're seeing lenders, there's been so much volume with refinances that they're kind of holding the floor, it seems like, for the most part in the 3.5 range. But if you look at what that does, if you're a home buyer and you're looking at a house for $350, the payment on a $350 house, with a 4.5 interest rate, which is where rates were 6 months ago. Yeah, not very long ago. The payment on a $350,000 house at 4.5% rate is around $1,775.
Okay.
So now that same $1,775 payment, you can buy about a $400,000 house. So in
a matter of like no time. That's incredible.
Right. So it's very cool. So now if you're having a hard time finding the perfect house, or if back to the 350 example, if you're looking at homes at 350 and they're not perfect and need a little work, you're not in love with it, but you really like the ones that are 390, but you're like, I don't want to pay the payment on that. You might want to check back into it because it probably is the same payment as you were previously looking at for 350. So nice opportunity to increase the affordability for homes.
Absolutely. I'm curious too. I'm sure a lot of people are, even though the rates are, monumental. We've never seen it before. Is it going to continue? What do you think? Should we wait? Should you kind of wait to hold unlocking or?
Yeah, everybody wants to know that. So it's what we're seeing is interesting. So rates fell so fast over the last 2 weeks that no lenders were staffed for this kind. Basically, everybody in the United States that has a house should refinance, and there's a capacity problem with that. There's not enough people at the lenders to process all those refinances. So, the lender has 2 options: either go to 3-month turn times, which is unacceptable, or raise the rates to control the inflow of loans. So we've seen over the last couple of days, a lot of, even though the market's still getting better, the 10-year Treasury is down 20 basis points today, which would normally translate to a huge movement and improvement in mortgage rates. Pricing is the same or worse than it was yesterday. So it's like kind of like if gas prices go down, but the gas stations raise the prices. It's backwards. But the reason is just there's a 4-mile line of people trying to get gas right now. So I think they'll settle down a little bit, maybe over the next few months. But unless you got your refinance started last week, probably those where they were last week won't be back for a while. So it's possible. We think like over the next 6 months, maybe there's continued improvement, but I doubt that we're going to see much of it in the next, I don't think you're going to get a better rate next week than you are now. If anything, it'll probably get worse until the lenders hire enough people and train them and work their way through all that stuff. So if you ever hired anybody for your business, they don't just walk in and immediately know how to do the job. So it's going to take a minute probably for that to happen.
Sure.
But you look at like historically speaking, they're the lowest ever. Could they go lower? Maybe, but they're the lowest ever. So bird in hand, I guess.
Exactly. And how about for closings, people that are under contract now or that are looking to be under contract soon? Because I know we've got a lot of people we're trying to find homes for right now. Are we looking at still a 30-day close, or are we to assume it should take a little longer with the influx of refis and obviously home purchases? What do you think?
It depends on the lender. So the lenders, we see some lenders out there that might be an eighth better in rate. And what they're doing is they've made the choice to go to the long-term times. So it's a seesaw.
Sure.
A lot of the lenders that we choose to work with, because most of our clients are purchasing homes, and it's more important for us to maintain 1-day underwriting turn times than have 1/8 of 1% difference in rate. So we're still 30 days. I don't think that should be a problem. But I think if you're working with a bank, probably you're gonna see those turn times extend out. One thing that it hasn't happened yet, but probably will, is I would suspect appraisal turn times are probably going to slow down across the board, just because everybody uses the same pool of appraisers and there's only so many of them. So right now there's still 8 days or so turn time, but it might add a few days to it, just depending on volume.
Sure.
But as far as I see, shouldn't be I don't think it'll extend closing time periods for purchase transactions.
Okay. Possibly.
Unless you're working with a bank. And like if you're working like Bank of America, Wells Fargo, those guys, I think Wells Fargo is currently requiring the loan officers to lock for 120 days. So they're but we'll see how that plays out.
Right. So what is the best rate that you've seen so far, like in the today or last couple of days for like your 30-year, your 15-year, what are you seeing?
Well, I locked actually the lowest 30-year rate I've ever locked in my life was for one of your clients about a week and a half ago. It was a 30-year fixed FHA loan. I locked it at 2.99% for 30 years.
Very happy.
It was weird locking. I've never locked anything with a 2 in front of it before. And then this week and last week, I saw some 15 years in kind of the high 2s.
Okay.
Most of the lenders have backed off that a little bit. So maybe you could still get a 15-year in the high 2s, but it'll probably be tough. 30 years are kind of like the mid 3s range, maybe low 3s, but probably around like 3.5% range is what I would expect. And then FHA and VA, they were in the 2s, probably now like low 3s is more realistic. But if you have a rate that starts with a 4 in it, then regardless of the type of loan, you might want to look into refinancing.
Sure. No, that makes really good sense. Well, thank you so much. Is there anything else we should be kind of thinking about as far as, I like the 4% thing. It's like, if you've got a 4 in front of it, this is the time you should think.
Yeah.
You should probably be thinking like now, like today. Soon.
Yeah. Cause I think that in our world, it's a race to see, because we have access to like 100 different lenders pricing, and a lot of our main ones are jammed right now, and they've started to basically put an artificial floor on rates. So we've had to go and circle back to lenders we don't use a whole lot to find out which ones haven't seen the volume spike yet. So we're kind of trying to find them ahead of there. Maybe we can lock a bunch of loans, then everybody finds out and the pricing goes up, then we go to the next one. So there's probably not that much longer before everybody has a floor. I was talking with a friend of mine who's over at BB&T Mortgage, and they just increased their par rate, which means you're not like paying any points or anything for 30-year, is now 4.625, which is way out of market, just because they can't handle the volume. So that'll probably happen everywhere. It's just a matter of time. So if you're thinking about it, I mean, you got lowest rates ever.
Right.
Could they go lower? Maybe, but I mean, it's the lowest rates ever. So if you have a 4.375 rate and you're trying to wait to see if it goes to between 3.5 to 3.375, you might miss the window and they go back up to 3.875 before you know it. So,
right.
But I think it'll be great for real estate market. It should be great for real estate values in particular, because as houses become more affordable, you'll see more demand for homes. So it's probably a great time to be selling your house.
I think so too. And one other thing I remember you and I talking about a couple of days ago was, I even remember searching for myself however many years ago when the market was, again, supposedly the lowest ever. And we chose to go even we looked at the 5-year and the 7-year because those were so much lower than your 30-year. And I think you even said traditionally they are, but you had an interesting point about why maybe they aren't now.
Yeah. So let me look at the yield curve. The yield curve has been inverted a lot lately, meaning short-term rates are actually more expensive than long-term rates, which is totally backwards. Right now they're not inverted, but the yield curve is very flat. So the reason for all of this is basically caused by these bond fund managers. So you go to PIMCO and some of these companies that manage big bond funds, or if you're in your investment account, you own bonds, those funds, the manager for those funds, if you read your prospectus, they can only invest in, they've already chosen, they might be only able to invest in bonds that have a maturity of between 3 and 7 years or whatever. They have some rules. They can't just buy whatever they want and put it in your bond fund. So as mortgage rates usually are pretty safe, or considered to be pretty safe, and pay a little bit more yield than like a U.S. Treasury. U.S. Treasury is paying 0.5%. A mortgage bond's probably paying, 2% or something. So you get a little bit more yield, which makes it more appealing for these bond managers to invest in them. But when rates go down this fast and everybody refinances, your average person probably keeps the same mortgage 7 years or so before they sell the house or refinance or life changes or whatever. So, but we have people where it's like we're on the 3rd or 4th refinance in 2 years. So the average, the bond managers are kind of scrambling a little bit because it's shortening the duration of the mortgages, and it's forcing them to go out and just to stay in line with what their prospectus is. Now they have to buy 10-year treasuries, even though the rate is, they're not getting any yield. They have to balance everything out. So it causes, as that happens, it drives down mortgage rates even more, which further exacerbates the problem. So it's kind of
vicious.
Yeah, I mean, it's great for our world and great for yours, but I don't think we've seen the end of it. I think that the 10-year treasury would be at 0.5% before it's all said and done, and mortgage bonds may continue to improve. I just don't know that if consumers are going to see the benefit of that until lenders can kind of catch up. But interesting times we're in for sure.
Well, I know you're a busy guy. How late did you stay up every night this week?
Feel like probably midnight or 3 a.m. almost. Now everybody I know, everybody over here is working till midnight. Yeah. But it's fun. I like it when things move fast. So we all enjoy it.
Me too. Well, Tony, thank you so much. I hope everybody found this very informative. I'm sure they did, because I know it's been a hot topic within our team and with everybody that we're working on. So we appreciate everything you do, Tony, and you might be getting some calls, so keep your phone on.
All right. Sounds good. Thanks, Stephanie.
Thanks, Tony. Take care.
Talk to you soon. All right, bye.